Welcome back, you legends. I'm Dr. Cal. Let's get right into it. The stock market today closed flat on the S&P 500, flat on the Nasdaq, slightly down, and slightly up on the Dow Jones, 0.7%. Let's take a look at the groups. Again, we're seeing a risk-off day with consumer defensive leading 1.2% up in the green. Basic materials 1.15% up. Cyclicals 0.7% in the green, financials 0.6%, industrials 0.4%, utilities and energy flat on the day, communication services, real estate, healthcare, and technology slightly down on the day. Let's take a look at the stock market map. We can see that big cap tech like Microsoft, Apple, Google, and Facebook were flat on the day. Tesla slightly down on the day. Amazon slightly up thanks to stronger than expected earnings from Walmart and Home Depot. But look at this, guys. Semiconductors. Semiconductors are a great gauge of risk appetite in the market, right? So when the market is moving up, you want to see semiconductors leading because this sector is the fastest growing and best performing in the tech sector. And then we have more defensive plays in big banks, Berkshire Hathaway. We have consumer defensives here, slightly leading the market. Again, this is all pointing towards a risk-off move. So why is Home Depot up 4%? It had a nice move up today, up 4%. It's because its earnings came in better than expected. But it's really bad news. Consumers pay more for less, boosting Walmart and Home Depot. The large retail chains report stronger quarterly sales as prices rise, inflation, and shoppers adjust spending. So the reason for the boost in the earnings, guys, is not that these companies are doing well. It's because everything is getting more expensive. So if, let's say if you usually buy a water bottle for $1 and now it costs you $1.20, you're spending 20 cents more, and that boosts the revenues of these retailers. But on an inflation adjusted basis, the revenues and the profits are actually down. They're not up. So this is really bad. It's driven by inflation and it's not good news. Let's take a look at the S&P 500. Look at this, guys. We're slamming right into that 200 daily moving average. We touched it today briefly and then retreated. The market is sitting at a critical level of resistance, hitting into the FOMC minute release tomorrow at 2 p.m. What I'm anticipating, guys, is something sneaky. I'm anticipating that the market will go again and test the 200 daily moving average, perhaps even do something insane and close above the 200 daily moving average. That sucks in a lot of bulls and then proceeds to reverse back to the downside just after that. So I'm actually waiting for something of a bull trap tomorrow. Keep an eye out, guys. Volatility will absolutely spike tomorrow because of the FOMC minutes. The VIX is starting to base slightly here, right? We've been flat for 4 days now after that massive sell-off in the VIX, or decline, I should say, in the VIX. We've seen 8 consecutive weeks of declines in the VIX, which is extremely rare. The more likely chance now that this week will close above last week, so we might see a jump in the volatility. Likely tomorrow we will see perhaps one last volatility crush to the downside, and then the next day we might see a reversal. That's what I'm anticipating. Something that looks like this, right? A massive crush. Everybody's super bullish. Yay. We closed above the 200 daily moving average. Let's go all in, and boom, a reversal the day after. Something like this, like that, and like this, right? Every single time we had a bullish crossover on the MACD with the VIX forming a low, we had a massive sell-off follow. Let's put the S&P 500 chart right on here so you can, guys, see what I'm talking about. Look at that. We had a bullish crossover. We topped I think a couple days later, and then we had that move sideways, and then the massive sell-off come in. In January, we topped exactly on that day, and then we had a massive sell-off and the beginning of the bear market. Right here, it marked the top and the massive spike in volatility and a massive sell-off. Right here again, it marked the top, and then we had a massive sell-off. and we're waiting for it now to mark the top. I'm looking for a bullish crossover on the MACD or the PPO. So keep an eye out, guys. Let's take a look at the 2-year yield. We tested the 50-day moving average right on the 2-year yield, and we have retreated. We've now rejected twice. It looks to me like the 2-year yield is waiting for the FOMC minutes tomorrow to either break to the upside or break to the downside. A decline in the yields will boost tech stocks massively. It will boost valuations. A jump in the yields will mean that the market is worried about inflation and about the Fed hiking rates even further than what is expected right now, which I believe is 3.5 to 3.8%, a terminal rate of 3.5 to 3.8 by the end of the year. So we'll see. Let's take a look at the 10-year yield. Same look here, guys. This is starting to look like a bear flag. Boom, we break down. Bear flag, boom, we break down. We will see if that happens. I am still waiting for a head and shoulders formation. This might have been the head and shoulders formation, right? But I'm still waiting for a possible larger head and shoulders formation for a final top in the yields. Let's take a look at the dollar. A massive indecision candle today. We tested to the upside. We retreated. Again, the dollar is waiting at a critical level. Look here, guys. I did say yesterday, watch for a break above 107. We did not manage to break 107. Watch for a break above 107. If we break and hold above 107, this will look like a bull flag, and that will lead to a continuation of the rally in the dollar and will lead to a massive crash in the stock market. Let's take a look at Bitcoin. I'm adding Bitcoin again because Bitcoin seems to be basing, right? We have this accumulation base right here on massive volume twice, right? We have a double bottom right here on the PPO. And we're sitting at the lower edge of this very long-term ascending channel that I've drawn up. And I do use these channels to track bottoms, guys, in stocks like AMD, Nvidia, in Bitcoin as well. So these are very helpful, these pitchfork channels. All you need to do is draw them up so that the bottoms connect and the tops connect, and you can see the trend very clearly. Make sure to set your chart to logarithmic. You don't want it to be set to regular because moves in Bitcoin are massive in terms of percentage points. So you want to set the chart to logarithmic. As a rule of thumb, I always set all of my charts to logarithmic anyway. Okay, so Bitcoin seems to be basing, but here's another guide that I want to look at. This is similar to the seasonality chart that I always show for the stock market. This is a somewhat of a seasonality chart. It tracks Bitcoin price action in its halving cycle, right? It halves about, I think, about every 3 to 4 years. We see a completion of a halving cycle. We are now in the trough of the halving cycle. It seems that we've already seen this massive last sell-off in Bitcoin. We've pulled that forward. Let me see, about 200 or 300 days pulled forward this sell-off. It remains to be seen if this is indeed a pull forward of this sell-off that usually comes in at around the 900-day mark. Okay, so Bitcoin is basing, it makes sense that it's basing around $20,000 because in every single bull market in Bitcoin, the pullback usually comes in at a level higher than the previous peak, right? This happened last time here. We had this peak here. We never got back to that peak of $1,000. The lowest we got was 3,000. This last bull run, this last bull market in Bitcoin wasn't as strong as the previous one. If you notice here, guys, the first cycle was the strongest, the second was slightly weaker, and the third is also weaker. We're now in the third cycle. So these cycles get weaker and weaker, so it made sense that when we tested the lows, we came back to the top of the previous cycle. So I do expect to see a base right here. Again, this sell-off looks like this sell-off right here. Right, we went from the middle of the channel to the lower border of the green channel, and eventually we had another test, and that was the last low. So I'm expecting something like this possibly again, and another test for the final low. And then we start to move parabolically. If you're a long-term investor in Bitcoin, it might be a decent time to accumulate shares at to accumulate Bitcoin, not shares, at $20,000. It might be a good idea. to accumulate as long as you accumulate and do not go all in, because it's not clear yet if this is the last sell-off. We don't know yet. We might see a continuation of the weakness well into late this year. So far, all indicators in the stock market point to June being the bottom. We will likely see a significant sell-off come in September and October, come at least to the $390 level. And the $380 level is my second price target. We're not likely to break the previous lows in June. Okay, so keep that in mind. It's unlikely that this low will break. There's a 97% chance based on statistics. I talked about these studies and statistics in the last video. Please check them out. There's a 97% chance that this low will hold. There's a 3% chance that this low will be taken out. And the highest likelihood, the highest probability event is that we see a 10% drawdown at least from this level right here. And again, guys, a 10% drawdown from, let's say, $432 at the 200 daily moving average will take us, look at that, 9%, 9.8 to 390, and a 12.5% will take us to 378 to fill this gap right here. So both of these possibilities, in my opinion, have a high likelihood of occurring. Now, let's take a look at the fear and greed index. We're sitting at greed. This is the second greed reading we've seen this year after the bear market started. The last greed reading we had was 62 in the late March, early April massive bear market rally. We haven't gotten to those levels yet. If we see a rejection below this previous reading at 62, that would indicate that the bear market is still ongoing, because look at this, guys. We had a reading right here at 77. The second reading was lower at 66. The one following that was lower at 62. So this reading should top around 58. Okay, so probably tomorrow or the day after, we should probably see a top around 58, because if you draw a resistance line, it will be sitting at roughly 58 on this reading. Market momentum, we have now broken above the 125 daily moving average meaningfully, significantly more so than we've seen in the previous bear market rallies. This is a bullish development. We're sitting at extreme greed readings again. This is indicating that a pullback is very likely. Stock price breadth is starting to base. Again, a nice bullish sign for the bulls. Put to call ratio, very low reading. Very low rating. The lowest reading since late April, right? So this is a very low reading, meaning that puts are cheaper to buy now than the previous 3 months, roughly 3 to 4 months. And what's making it a really good time to hedge your position to protect against the downside. Or if you're bearish and you want to short the market, it makes it a really good time to buy puts on the market. Market volatility, neutral. It's sitting at 20 and it has now based at 20. It is now flat at 20. Again, a lot of things point towards 20 being the next launching pad for volatility to move up. Safe haven demand. This is the difference in 20-day stock and bond returns. It has now flattened. In fact, guys, I did talk about this negative divergence in the high yield bonds, the junk bonds, the risky bonds as compared to the S&P 500. We've made our high right here on the 11th, and we've been moving down as the S&P 500 has been moving up. This divergence, guys, marked the top right here and marked the top right here, okay? As the market kept pushing up, we had a divergence in the HYG, and it ended up marking the top. Same thing happened in April. Same thing happening now as we're running into this major resistance. A lot of things are lining up to indicate that this is the top on this rally. Now let's talk about earnings beat data, sitting at 60%. Absolutely awful reading. Horrendous reading. 60% is absolutely horrendous, especially considering that the earnings forecasts have been cut and companies are still failing to beat those cut earnings expectations, those reduced earnings expectations. You might look at this and see, oh, 60%, it's above 50, it should be okay. No. In reality, the reading you want to see is at least above 70. We want to see 75 plus. This is a 15% plunge in the earnings beat data as compared to the run-of-the-mill bull market. So again, we're seeing a recession, a beginning of a recession in earnings. Earnings are declining, and I expect that earnings will continue to decline as the economy weakens. And we see that massive recession that the yield curve inversion is predicting will occur in the next 6 to 18 months. This is Walmart earnings. It beat 10%. It beat the expectations on earnings, 10% surprise, and on revenues, 1% surprise. Keep in mind that those earnings expectations have been revised down, so it's beating an expectation that is actually pretty low. And nevertheless, it ran to $140, up from the $120 low after they came out and said that they've cut their expectations. The market is happy that they've reiterated their forecast for the second half. They've not cut the forecast for the second half. So the market is happy about that. Now we're seeing Walmart rally. We're seeing Home Depot rally off these less than awful earnings results. Walmart sticks with second half outlook after earnings beat expectations. The company reiterated its outlook for the back half of the year, and the market was happy about that. Let's take a look at the economic events coming up. Tomorrow we will have the FOMC minutes coming in at 2 p.m. We also have retail sales month on month coming in. I expect retail sales to probably beat, based on what I'm seeing from Home Depot and Walmart. There's a chance that they will beat. That will be bullish for the market. And if the FOMC minutes come in dovish, more dovish than expected, that will lead to a even stronger rally in the market. But keep in mind, guys, the Fed does not want to see a rally in the market. The Fed wants the market to continue to sell off slowly. Why? Because the Fed is focused on crushing inflation. The way to do that is for people to reduce their spending. For you to do that, you need to make people feel like they're not as wealthy as they were in 2021. And it's called the wealth effect. You want the stock market to decline so that people feel like they're not as wealthy, and that will lead them to reduce their spending. Another thing that the Fed wants is for the jobs market to loosen up a bit. They need the unemployment rate to rise to at least 5% from 3.5%. That will alleviate some of the inflation in hourly wages, again leading to some cuts in people's spending habits. The point I'm trying to make, guys, is that the Fed will probably want to talk the market down. They will have that opportunity to do that at the Jackson Hole meeting at the end of August. At I think the 27th of August, they will have their annual Jackson Hole meeting. So I expect Jay Powell to come in and talk the market down. Again, that also matches seasonality. Right here, guys, we have our seasonality chart for midterm years. We tend to see a significant sell-off towards the end of August into early September, another sell-off towards the second half of September, and one last sell-off towards the back half of October, and then we see a very nice rally in November, December. So this coincides with the Fed meeting at the 27th of August, and then we have seasonality weakening, pushing the market down. So I do expect to see the market begin to sell off significantly in the last week of August into the first week of September, and then perhaps rebound slightly and then push back down again. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.